What's up everybody, Steve here. I live in Southwest Florida, and in Florida we have hurricanes, and I'm sure you've all heard this saying, when the dust settles. And when a hurricane comes through, a lot of times you really don't know the significance of the damage until really after the hurricane has passed. And I think the same is true with the US economy. So an article that just came out, I'll put a link in the description below. It says the Fed meets and they expect 3 interest rate hikes in 2022. Now, if you're not aware, we've been buying $80 billion a month worth of US Treasuries, as well as $40 billion a month of mortgage-backed securities. And I think it's having an adverse effect on what's to come for our futures. And ultimately, if we're in a healthy economy, why would they be putting so much money into the system? So I'm gonna jump into this article and read a handful of things that I think everybody needs to pay attention to, because it will have an effect on you, your family, and your future. So let's jump into it. It goes on to say, in an abrupt policy shift, the Fed will also stop boosting bond purchases twice as fast as planned and possibly halt the program altogether in March. Now, if they do that, and if they completely stop all these bond purchases immediately overnight, say in March, we're going to see a collapse, in my opinion. It goes on to say the Federal Reserve will quicken the pace at which it's pulling back its support for the post-pandemic U.S. economy as inflation surges, and it expects to raise interest rates 3 times next year. The Fed's key rate, now pinned near zero, influences many consumer and businesses' loans, which rates will also likely rise. If you guys are in any kind of adjustable rate on any kind of loans out there, any kind of debt that you took on, be sure that you guys refinance, pay them off, or just ultimately get into some sort of fixed loan rate, whether it's a small business loan or a personal loan, because we're going to see rates just skyrocket, in my opinion. The shift marked Jerome Powell's acknowledgement that with inflation pressures rising, the Fed needed to begin tightening credit for consumer and businesses faster than he had thought just a few weeks earlier. The Fed had earlier characterized the inflation spike as mainly a transitory problem and would fade as supply bottlenecks caused by the pandemic were resolved. But the run-up in prices have persisted longer than the Fed expected and has spread from goods like food, energy, autos, to services like apartment rents, restaurant meals, and hotel rooms. So essentially what they're saying is inflation's getting out of control, and they need to stop the amount of money infusion into the economy, making credit more difficult to get, and also paying higher interest rates. The Fed's new policy shift does carry a risk. Raising borrower costs too quickly could stifle consumer and business spending. That in turn would weaken the economy and likely raise unemployment. Yet if the Fed waits too long to raise rates, inflation could surge out of control. It might then have to act aggressively to tighten credit and potentially trigger another recession. Many economists expect high prices to persist. Housing costs, including apartment rents and cost of home ownership, which make up about 1/3 of CPI, Consumer Price Index, has been rising at a 5% annual pace the last few months, economists at Goldman Sachs have calculated. Guys, this is what I've been saying on this channel for a while now, is if you guys are in debt, you have personal debt, you have personal liabilities, be sure that you guys are doing everything in your power to make sure that you're getting into fixed loans. Because if you're on any kind of adjustable loan, you're going to see maybe right now you're in, say, a 3, 4, 5, 6% adjustable rate, and it could overnight jump up to 9, 10, 12, 18%. So if you guys are in any kind of loan that is adjustable, be sure you guys fix them. And also, if you guys have assets, and again, this is not financial advice, I'm not a financial planner in any sense, but if you do have assets, you might want to consider cashing out certain assets to pay off any kind of personal debts. You guys want to have a foundation, a financial foundation coming into this new market. I think we're going to see maybe even a depression, and when that happens, I think that there's going to be a lot of deals to hit the market that we're going to be able to invest into. So the best way to capitalize on that is get rid of any kind of personal overhead, any kind of personal liabilities. Again, I'm going to put that link for that article so you guys can review it on your own, and let me know your thoughts. What do you think is going to happen in the future of the economy in the next year, 2, 3, 5 years? Let me know in the comments below, and I appreciate you guys being here with me today. Thanks a lot.